Welcome to today's video. Majority of us lives on a paycheck to paycheck basis, and whenever we face emergency financial situation, we just struggle. In today's video, we are going to talk about emergency fund. Emergency fund is created to meet any kind of unplanned, unforeseen situations. It is not for routine or a day-to-day expenditures. The few examples of emergency situations where we can use emergency funds are job loss, medical, unexpected tax bills. Emergency fund is not for social emergency like family and friends get together, going for a vacation, etc. The next concept is how do we build emergency fund? It would be challenging for most of us to build it overnight. Hence, it's important that we start the process and gradually build the corpus. There are two ways of doing it. First is the SIP or a systematic investment plan, where you step aside a fixed sum every month in a different bank account so that it kind of creates a corpus which you desire to have. The second is that you can invest a part of your annual bonus to create the fund or increase the speed at which you want to create this fund. The next concept is what are the considerations which we need to take care of while deciding on the emergency fund. The number one starts with safety and security. Safety is the utmost important for creation of emergency fund, because we will be relying on this fund for a very urgent needs. Hence, this should not be invested in any kind of riskier assets. Say for example stock market, because the market may be unfavorable at that point of time for redemption. Hence, we need to decide basis where we can safely invest. Point number two is that we should have access to this investment at any point of time. We cannot invest in instrument which will have a locking, or when we want to withdraw the fund, we have to incur any kind of exit charges, as it would be unfavorable and counterproductive to this emergency fund. The third point is that we don't mix the investments and emergency fund. We should make a clear distinction of the amount which we are investing on a long term and the funds which are earmarked as emergency fund, so that it is easier we can decide where we will invest this money. The fourth is impact of taxation. What are the amount which is residual after the taxations will help us to choose which avenues where we can park this emergency fund. Hence, we need to calculate the post-tax return from this deployment of emergency fund. The next important concept is the quantum. Each individual has different financial needs. Each of us has unique combination of lifestyle, income, unavoidable expenditure and dependence. So hence it's important that we chart out our expenses. Before we decide on the quantum, we should draw what is the minimum amount which we require for sustenance or meet these essential expenditures. And essential expenditures should consider our requirement for food, clothing, shelter, house rent, EMI, etc. It should not include discretionary expenditures like traveling, watching a movie and so on. Once we know our essential or unavoidable expenditure, then on that amount we need to keep at least 6 to 9 months of this expenditure. In case I give an example, if you have an income of 1 lakh and this essential expenditure is around 50,000 rupees, you need to keep 56x of this 50,000, which is 3 lakh rupees, into parked under this fund. Or if you want to keep 9x of this, then you can park 4.5 lakhs, 9 into 50,000 rupees, that is 4.5 lakhs into emergency fund. Essentially, it talks about keeping minimum 6 to 9 months of essential expenditure parked under emergency fund. The next important concept is, where do we invest this emergency fund? We can invest in cash where we don't get any return as such, but it is the most liquid form where we can use it instantly. The second is savings bank. We get some nominal return, but the return is very less as compared to the rate of inflation in India. Also, we can convert it into cash instantly. So cash and savings bank account is most liquid form. Apart from that, there are a few other innovative products from the banking, like sweeping facilities, where once the amount crosses a certain threshold, the amount gets parked into some kind of short-term fixed deposit, which will fetch you higher interest than a pure savings bank account. Also, we can park the money in a short-term fixed deposit, which will give us a return higher than a savings bank account. Lastly, and a very critical, is liquid mutual fund. Liquid mutual fund is a mutual fund which invests in debt instrument consisting of fixed income securities. It is one of the easiest way to withdraw fund, where you can get your money, say, in 1 or 2 days. And most cases you don't need to pay any kind of exit load or pre-withdrawal penalty. Also, we get taxation benefit. It is considered as a capital gain, and we get benefit of indexation in case we don't need to withdraw or redeem this fund within a period of 3 years. It is important, wherever we invest, we should check what is the withdrawal penalty in all the cases, and accordingly decide where we need to invest. And regarding the quantum or mix, we can invest roughly 20 to 40% in cash or savings bank, and the balance in liquid fund, which will consist of, say, somewhere between 60 to 80% into this fund. It is important that we don't invest in risky assets like stock, gold, or real estate investment. Real estate investments is also illiquid. For example, in case you want to convert this real estate into cash or bank, it takes a pretty long journey. Finally, we should review our requirement of emergency fund at least once a year, as there could be change in our life. For example, we might have started a new business, taken sabbatical at work, addition of a new family members, change in our lifestyle, which could impact the amount of emergency fund which we have hold. I would like to thank you for watching this video, and I hope you find value in this video. If you did, you can like this video. See you next time.